Assalamualaikum and a very good day to everyone. Firstly, I would like to welcome all of you to the webinar of comparison between regulation of Islamic finance and banking and the conventional system in Malaysia. My name, Azyani Fahira BINTI ANUAR. It is a pleasure for me to be the moderator for today's program. A lot of meaningful knowledge and information will be shared throughout this program. Therefore, I really hope that all of the attendees can stay with us, lend us your ears to listen to the meaningful sharing by our professional speakers. And on behalf of the organizer, we hope we can both benefit from this session. Without wasting more time, I will introduce three panelists who will share their opinions through and thoughts on today's discussion, which is Ms. SUHAILAH, Ms. NURHANIS and Ms. MARYAM. Before moving on to the first question to our first panelist, I want to provide some introduction and a little bit of history about the regulation of Islamic finance and banking and also conventional system in Malaysia. Islamic banking, also referred to as Islamic finance or Sharia compliant finance, refers to financial activities that adhere to Sharia or Islamic law. Two fundamental principles of Islamic banking are the sharing of profit and loss and the prohibition of the collection and payment of interest by lenders and investors. Islamic finance is a rapidly growing concept in the modern world. It's a process of banking or financing activities which is based on ethical and religious principles. Islamic finance or banking can be termed as interest-free banking. Islamic financial institutions are those financial institutions which operate according to the Sharia principles. The legal and regulatory framework for a financial institution regulates the operation of the institution to help to achieve their objectives. The acceptance of the Islamic finance internationally required the countries to enact legal and regulatory framework for the better operation of the Islamic institution. The Islamic financial institutions are based on the Sharia principles and also domestic law, which is common law or civil law, shall not be able to regulate the Islamic financial institution effectively. The Islamic financial institution in a country may be governed either solely by enacted provision based on Sharia law or the existing domestic law has adopted to needs of Islamic financial institution. Many countries has adopted the regulatory framework for Islamic finance with international standard, which can substitute the conventional framework, which is one of the Islamic Financial Services Act 2013 (IFSA) is the example for the Islamic finance sector and reference status. Next, I will explain about the definition of the conventional finance and banking system. Banking has been around since the first currencies were minted and wealthy people wanted a safe place to store their money. Ancient empires also need a functional financial system to facilitate trade, distribute wealth and collect taxes. Banks were to play a major role in that, just as they do today. The Financial Services Act 2013 (FSA) is the key statute governing the conventional finance industry. It replaced the Banking and Financial Services Act 1989, the Insurance Act 1996 and the Payment System Act 2003, and the Exchange Control Act of 1953. So, the first question for this webinar will be addressed to Ms. SUHAILAH. Ms. SUHAILAH, from what I know, every investment definitely has profit and loss, and making loan will has an interest charge. Can you explain the differences between Islamic system and the conventional banking system?
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is SITI SUHAILAH binti RAOP. My matric number is 277089. Okay, every investment definitely has profit and loss, and making loan will has an interest charge. So, I will talk about the comparison between Islamic finance and banking and the conventional finance and banking in Malaysia. Okay, firstly is about the interest. For Islamic finance and banking, there are non-guarantee return may be given as hibah, and the rate of return must be an indicative rate. They will not be charged interest, or also known as interest. In Islamic finance is free from interest, which is the backbone of conventional banking and financial system. Islam prohibit the interest known as riba, not as law as the land, but as divine or the living, no space whatsoever to argue or put a case forward otherwise. It is compulsory for Muslims to completely evade from riba in their commercial and non-commercial daily activities. The Islamic banking and finance is a system designed to allow Muslims to deal with their financial affairs in accordance with their belief. Next, for in conventional financial banking has fixed interest rate and deposit are fully guaranteed. It is because conventional banker have learned that deposit pricing can be used to shape the kind of customer base each bank can best serve. Changing the deposit price affect to not only spread between bank loan rate and deposit interest rate, but also customer balance and deposit mix decision, which is often influence both bank growth and profit margin. Point out deposit pricing is best used to protect the increased bank profitability rather than to simply add more customer and to take market share away from competitors. Next is about the profit. In Islamic finance and banking, making a profit in a way that does not conflict with Islam. Profit is generated from sale and purchase contract, and profit and loss sharing, but in the conventional finance and banking are reaping profit through various means, regardless whether it complies with Sharia or otherwise interest. The interest result from surplus of the amount of loan or debt given it has the usury. Islamic banking use the concept of real profit and risk sharing and does not involve both parties or one of the parties involved. For example, in the Mudarabah contract, customer as investor and bank as entrepreneur share profit when making profit, while losses will be borne by investor. This coincides with the method of faith, which means every return is at risk. This actual profit and risk sharing is fair and does not burden any party involved. In contrast to the conventional investment that promise a fixed return at the beginning of the contract, which this investment do not involve actual partnership between the parties involved. The fixed return promised at the beginning of the investment contract is usury and haram in Islam. So that's all for me. Thank you.
Thank you, Ms. Suhailah, for such a wonderful explanation. Now, Ms. Hanis, can you explain the difference between risk transfer and risk sharing and elaborate more on risk sharing?
Thank you, Ms. Aziz, to moderator. Allow me to explain more about risk transfer in conventional banking and risk sharing in Islamic banking. Okay, first of all, Islamic finance is any finance that is compliant with the principle of Islamic law, the Sharia. In terms of finance, Sharia explains as in details the ethical concept of money and capital, the relationship between risk and profit, and the social responsibilities of financial institutions. In Islamic finance, we does not endorse with risk aversions. We also does not endorse with speculation and gambling. After all, the element of risk legitimizes all Islamic transactions, as transactions without risk are unaccepted according to Islamic finance.
For your information, risk could be defined as the probability of occurrence of event resulting in a loss. Risk is not limited to default risk, but extends to any type of risk that will eventually causes loss, such as market risk, capital risk, and economic risk. As a general rule, all risks faced by conventional bank must be transferable as the nature of the financial transaction must, as far as possible, allow for the transfer of risk. Whenever the opportunity arises, the bank must be able to quickly pass the risk of the asset or valuation to the customer. As we all know, conventional financial institutions operate within a system based on debt and transfer of risk. This raises the probability of disconnecting financial instruments from their underlying assets. Some of the financial tools created to share risk actually resulted in a concentration and intensification of risk. In contrast, Islamic finance emphasizes asset backing for transactions and is anchored on the principle of risk sharing. Sharia principles will ensure a direct link between financial transactions and real sector activities. Sharia principles also prohibit speculations, as I said earlier, the use of excessive leverage, and avoid many forms of complex securitization.
The risk-sharing characteristic of Islamic finance can also foster financial stability. By design, Islamic financial instruments inherently reduce reliance on interest rate-based debt contracts. The first characteristic is Mudarabah, which is profit sharing, and Musyarakah, joint venture, that emphasize equitable risk allocation among different parties. Musyarakah in particular ensures that the impact of an adverse development, such as losses, is spread among the participants evenly. Takaful also has the potential to spread the risk among a large number of participants. Lastly is Sukuk, which is certificates of ownership that use the concept of joint ownership of an asset by several financiers and make it more like quasi-equity as opposed to a bond, which is pure debt instrument with risk sharing. Reliance on equity and equity type financing arrangement helps to restrain excessive leveraging. This close linkage between the amount of financing and an underlying asset also helps to limit the leverage. The sharing of risk and reward implies that long-term targets become more important and excessive short-term risk-taking is discouraged. Financial institutions are more like business partners with their clients and have stronger incentive to evaluate financing requests carefully and exercise prudence in extending such finance. In conclusion, I can say that the principle of profit and risk sharing is the foundation for all Islamic economic activities. Consequently, banks and financial institutions are invited to partner with entrepreneurs or clients instead of lending them funds in exchange for fixed future payments. Thus, should a risk materialize, both parties would bear the risk in proportion to their capital contributions. However, as to the distribution of profits, parties are free to agree on their profit percentage, notwithstanding their capital contributions. And it is very important to note that in an Islamic structure, profits and risks depend on the performance of the enterprise or the business venture itself, and therefore cannot be fixed ex ante. This protects the system against a general fall in asset prices and reduces the probability of cascading defaults. The sharing of users also reduces the probability of contagion to the rest of the financial system. Other than that is the policy that issued to this matter. Risk sharing is from the section 19 of IFSA 2013, and another one is section 139 of FSA. I think that's all for me. Thank you. I think we can go back to the moderator, Ms. Azyani.
Thank you so much, Ms. Hanis, for a very concise and helpful explanation. Moving on to the last question, which I will ask to Ms. MARYAM. Can you tell me what is the differences of regulation between conventional penalty fee and Islamic late payment charges?
Assalamualaikum warahmatullahi wabarakatuh. Thank you, moderator. I, MARYAM SOFIA binti MIOR SHARIMAN 281270, would like to talk on the subject of late payment charges and its Islamic regulation, which goes by the term of ta'wid and gharamah. I think it is best if we have a clear context first on how these three mechanisms are defined and adopted. Default is the failure to meet financial commitments or legal obligation of a loan. For conventional bank, late payment charges or penalty fee is considered as their income and constitute a sizable chunk of the bank profitability. While in contrast, for Islamic financial institution, says customer fails to meet or to make prompt payments, the customer shall undertakes to pay charity, which is credited into the charity account for disbursement to charitable organisation. In Malaysia, ta'wid and gharamah are used as the two mechanisms adopted to avoid detriments to Islamic bank. Ta'wid is referred as the amount that may be compensated to Islamic banking institution based on the actual loss incurred due to a default. But for gharamah, it is defined as the penalty charged on defaulters over and above the ta'wid according to BNM 2011. In Malaysia, mechanism to handle default case does not start from the point where customer default. On 22nd January 2018, the BNM has released the policy on credit risk for banking institution, insurance and takaful operators and financial handling companies, which this policy document has been issued pursuant to section 47 subsection 1 and 266 of FSA 2013 and section 57 subsection 1 and 277 of IFSA 2013. Conventional bank in practice charge cumulative interest on late payment charges and defaulting customer. For credit card late payment charges, the BNM has released the tiered pricing system. The tiered pricing system. We have 3 tier which will be charged on the maximum 15%, 17% and 18% per annum respectively. As for personal loan and home loan, the charges imposed may be vary between banks, but usually it is the minimum of 10 ringgit or 1% of the total outstanding balance, whichever is higher, which can be really add up if the customer do not take this matter seriously. Rate charges by the conventional bank are compounded and the penalty will be included on the loan amount. But for Islamic banking institution, in order to maintain financial discipline among the clients, the BNM referred to the guidelines on late payment charges for Islamic Banking Institution 2012 LPC guideline, which is exactly issued by the BNM itself. The SAC of the BNM has resolved the adoption or the imposition of the ta'wid and qaromah as the late payment charges by Islamic banking institution, which is permissible according to BNM 2010. Late payment charges on judgment debt for cases involving Islamic bank is also sanctioned under Order 42, Rule of 12A, Rules of Court 2012. So, on the 10th meeting of the SAC of BNM on May 2010, the Council has ruled that the permissibility of post ta'wid and qaromah is permissible as long as it is subject to this condition, which is ta'wid can only be imposed on late payment charges arising from the financial contract of exchange contract and lending contract, and it can only be imposed at the end of repayment period, which both parties must agree. And Islamic bank can recognize ta'wid as their income as long as it is the actual loss suffered by the Islamic banking institution. But for qaromah, it cannot be taken into account as their income. Instead, it must be channeled into the charitable organization, which is approved by the SAC. Thank you.
Thank you so much for the explanation, Ms. Maryam. I am very sure now the audience, including myself, have learned the comparison between regulation of Islamic finance and banking and the conventional system in Malaysia. So, in conclusion, the financial market in Malaysia continued to attract steady foreign direct investment due to its strong performance and growth. The greater pace of development in banking industry and financial sector has given confidence to global investors and financial players to invest and secure partnership in the country's growing market and business initiative. The steady growth of market and banking industry helped Malaysia to march into new benchmark of financial sector in the future. It was expected to bring steady progress and unprecedented growth in Malaysia's banking industry for tomorrow's world of finance. This strategic market provided the banking indispensable tool to joining the bandwagon of other developing industries and financial powerhouse in Southeast Asia in chasing the new pace of development in the postmodern world. However, the Islamic finance and banking regulation in Malaysia is better than conventional system. This is because the Islamic finance and banking regulation will not involve in anything that is unlawful or haram, which is such as riba, gharar and maisir. Well, attendees, we have reached to the end of our webinar session. From the organizer, I apologize if there is any mistake on our part, and million thanks to the panelists, the participants who are willing to attend this webinar session. We hope many people can benefit from this webinar. I am Azyani Fahira, your moderator today. May we be given the opportunity to meet in the future. Assalamualaikum and have a good day.